What is up, college money hustlers? Welcome to another episode with your co-host Dwight Van Dyke.
And Elliot Bernard. What's up, everybody? Welcome back to our new episode.
Yup. So right before we jump into things, I just want to shout out everybody who's been supporting us thus far. Don't forget to like, subscribe, and share with a friend. We really appreciate the support, and we really just want to keep pushing this. So keep watching the videos, show them to friends, like, subscribe, all of the above. Screenshot and share on social media. Follow us at the College Money Hustle. I'll put it somewhere on the screen for you guys to see.
Yeah, but big ups to everybody. Appreciate the support,
Mm-hmm. Yeah, so Elliot, what are we going to talk about today?
So today, this guy's asking me like he doesn't know, but today we're going to talk about the different types of, I guess you could say, market that happens. Like you have the bear market, you have the bull market, and then you have the new market, which is the kangaroo market.
Market.
That's a new topic. I studied finance, but never heard of the no kangaroo market, but it's a reality.
I don't think anybody has, to be honest, but yup, as Elliot said, it's clearly a reality. It's up and coming, I guess. We always had the bull versus the bear, and the
kangaroo joined the mix. He's like, you know what? I'm here now. So now we got three animals. So yeah, we're gonna go through that and what they stand for and what are the scenarios, what to anticipate and stuff like that. So, all right, Dwight, you can kick us off.
So we're gonna go over the bear market real quick. For those who don't know, a bear market is pretty much where the market has been in a consistent and continuous decline over a period of time. Usually it's described as when the price falls, the price of the overall market, so say the S&P 500 or the Dow Jones Industrial Average falls 20% from its recent highs. So obviously in these times, people are really going through it essentially, because the reason that prices decline is because there's no demand for assets. A lot of people are just selling off their stuff. Maybe unemployment rates going up, which causes people to lose their jobs. Companies are laying off people, therefore the prices are falling, and it's usually just not a good time. A recession usually follows these periods of time in the bear market.
Yeah, so like Dwight said, it's pretty much the demand, and that goes for a lot of things. When there's no demand, what happens to the price? Price decreases also. So it's pretty much the logic of supply, demand, and pricing anyway. So definitely, a bear market. Like, what do you do in a bear market though? So do you just buy? Do you just continue? Is that when you should buy more, or is that when you just sit down and sell off your asset or do nothing? For me personally, my belief is that no matter the market, you just keep doing the same thing, dollar cost averaging and that kind of stuff. So it's not financial advice, but that's my logic towards it, because although you have these different type of markets, but like we've always said, no one knows when it's gonna happen. People can try and estimate, right, Dwight? People can try and estimate, but can they really say, tomorrow is going to be a bear market? Or actually,
no, they can't.
Yeah, the first 2 months of, 2022 are going to be bear markets or something like that. You can't really, so.
So I kind of take a little bit of a different approach from Elliot. Elliot does dollar cost averaging always and forever, I guess.
Man, I'm just making my life simple,
Yeah, no, it 100% is simple, and it proves to be very effective.
Yeah.
If you want to know how effective it is, go listen to our previous episode. It was last season, I believe. We did talk about dollar cost averaging. But my philosophy is a little bit different. So I do.
All right, what's your philosophy, Dwight? I don't even know it.
Yeah, I don't. I haven't even told this guy, but I do dollar cost average regularly. Although, if there is a decline in the market, I will put in more money than I would normally do when I'm dollar cost averaging. So if the price is, theoretically, if I'm putting $2,000 a month in my investment portfolio, if the market is consistently going up or might take a little down, I'll continue with that 2,000 a month. However, if I see a sharp decline, so in March we had the sharp decline. A couple weeks back, I know there was a slight decline that was big enough for me to feel confident going in the market and putting a little bit more money in, because to me, when the stock's down, it's on sale. That hallelujah, praise the stock market, but it is on sale, and I'm putting more money in. That's me personally, but unfortunately, most people do not think like this, and it is extremely detrimental to their portfolio. So a lot of people actually do the exact opposite, and we'll get into that later. But yeah.
I mean, I'm not gonna lie, I kind of do that at the same time. For example, like companies that I believe in, if I'm talking about single equities, like AT&T, for example, companies that I believed, I would buy more when I believe the price is so low that, it's pretty much a bargain at this point. So I agree with that. But, I guess I'm speaking in general, I guess, for example, if I'm speaking about like my Roth IRA, I don't really go into it and, try to buy more, although that could be very useful for my future gains. But I definitely kind of agree with your methodology anyway.
Yeah. So now we're going to hop right into the bull market, which is
the bull market,
the exact opposite of the bear market. And, we have the bear versus the bull. But in this case, the bull...
Who would win, bear versus bull?
Well, that's the thing. They say, I've always heard this saying, the bull climbs up the stairs while the bear jumps out the window. So when you see a decline in the stock prices, it's usually fast. Like within days or within a week, you will see drastic drops in the stock price. However, when stocks are rising, this isn't the case. I mean, on average, at least, there's obviously anomalies and outliers where you have stocks that jump up stupendously
for sure.
within a couple days. But in most cases, the bull market, which is when the market's consistently going up, takes time. It goes up maybe
very much so.
0.5%, 0.25%, 0.75%, 1% a day. And it's gradual decline. It takes more time for the market to just go upwards. And that's usually just because when things are good, people are kind of, I guess you could say, more consistent than when things are bad. When things are bad, everybody just wants to dump all their...
irrationality takes place.
Exactly, so that is the saying. That's how I always used to remember when I first got into finance. The bull climbs up the stairs, the bear jumps out the window. So,
I've never heard of that one. Yeah, so I don't know if you make it up. Did you just make it up?
I actually have no idea where I heard of that.
I think this guy made it up, man.
No.
I gotta quote check you on that one.
I can't take credit for this because I actually didn't come up with this, but for some reason that just always stuck in my head. But yeah,
all right.
Demand is increasing during these times. People are usually buying more because prices are going good. Everything's looking good.
Yeah.
So people want to buy more. Thus, as we said, creating more demand and making the prices go up.
People are definitely optimistic. Yeah. Optimism is at its peak. At this point, because I mean, it's just. Like Dwight said, it's like continuous over like a period of time for you to be able to say, we're in a bull market. Usually, I think for the last couple of years, we have been in a bull market for sure, where we've seen year over year continuous increase in terms of return from people that have invested money in the major indices. So pretty much so.
I'd say the entire time that you and me were in university, it was just a boom and bull market, I'd say.
Yeah, I definitely would agree that we had that one period, I think, in like
2018.
2018. The December of that year, or like the winter of that year. I don't remember what happened. There was just a drastic decrease, and that's when I actually bought some assets like Facebook and stuff like that, but I sold them off to go to go on spring break. So that wasn't a good choice because those were good buys, and but that's okay. The past is the past.
Live and learn. You some good money.
Exactly. but live and learn. Anyway, so
Exactly.
now, what do we have? We have Mr. Kangaroo.
Oh yes, the
That
Kangaroo.
one, that one is a new
Brand
one.
new.
How do you even define that one? Like, because I don't know the exact definition. Bull bear,
So
those one are
there is
traditional, but
no
kangaroo.
definition. This is the kangaroo market is just something people have been throwing around now. If
Yeah.
you have been paying attention to the stock market after March, you would see what we mean by this.
Mm-hmm.
You've seen a whole lot of rally, like every single day. If you have
Man.
CNBC on your phone or on your TV or whatever,
Yeah.
it'll be like, oh, the stock market's up like 300 points today. Blah,
Yeah.
blah, blah. Things are looking good.
And
The
then
next day,
tomorrow is the worst
oh,
day.
the stock market went down 400 points. The more
Yeah.
cases, blah, blah, blah. So that's pretty much what we mean when we say kangaroo. The market's
Kangaroo.
just jumping up and
Yeah, you
down,
know how
up and
kangaroo
down.
be all over the place.
All over
I
the
haven't
place, yeah.
I haven't seen a kangaroo yet, but
Neither have I, but
I've
I
heard
just
they're
assume
always jumping and stuff like that. So that goes for, but in the kangaroo market, I think what you need is just a strong back, to be
Yeah.
able to, just weather the storm, and when
100%.
things go extremely south, like, extremely bad, all you can do is just stand and kind of at that point take it, and you'll survive at the end. The goal at this point is survival and not to do anything irrational, because that's what defines your future. It's the reaction that you take in the present. So in this case, the best reaction is no reaction, and to just, I believe, continuing.
Boom. I'm about to drop a bomb on that, bro, when I edit this, bro. That's game right there. All right, so now that we've gone over the kangaroo market, it's uncertain times. It's best to just do whatever you were consistently doing before and wait for the market to become less volatile. But now we're going to go into opposite behavior. And this is something, if you haven't already, The Intelligent Investor by Benjamin Graham.
Jeez. Big book.
I'm shouting this book out. It's like the Bible. It's extremely thick, but there's a lot of gems in here for investors. But Benjamin Graham pretty much says the intelligent.
This guy's reading from it. Oh my
reading
gosh,
from
like
it,
a
yeah,
Bible. Go ahead.
I'm preaching.
I'd preacher.
The intelligent investor realizes that stocks become more risky, not less, as their price rise, and less risky, not more, as their prices fall. Man, that is, people don't realize it. It sounds so simple. It sounds so simple, but people don't realize this, because when the market's doing amazing and your assets are up like 20-30%, everybody just wants to keep buying more, not realizing they're buying a more risky asset. The price is
Exactly.
20-30% is now more risky. You're more likely to lose money on that gain. But what your best option to do is actually to sell at those high prices. It's high, maybe overvalued, which would mean the best time to sell. But you sell at these high prices, and then you're good. You take your profits while you can. You don't pump more money into a rising stock that's potentially overvalued. And that's what a lot of people don't realize. And the exact same, and probably even more important, is when the market is down, you don't just sell off all your assets for a loss. It's, as Ellie said, that's just irrational, and as Benjamin Graham would say, that's not what the intelligent investor wants to do. They don't want to sell their assets for a loss just because the market's down. The market's always going to have fluctuations, as we said, the bear versus the bull, and now the kangaroo's jumping in, kicking mans. You don't want to sell for a loss, and you don't want to buy when the price is extremely high.
Yeah, I mean, I don't even know what to add to that, except to the point that, we're just preaching today, except that, it's just about being disciplined in what you're doing. And, if you're doing investing in broad indexes, then you should just believe in the foundation that what goes down comes back up. And if you're going to take the route of either investing more when you believe it at a sale, then do that. But don't just sell it off. And if you're investing in single equities, then it is your job and duty to understand those companies. And hopefully those companies that you're invested in, you believe that they will be around for at least the next 10 years is what I'm saying. You believe in their product, in what they do, and you believe that they will be there. So if you believe they'll be there in 10 years, when it goes down, logically you'd think you want to buy more because you know this is going to grow in value, and it's just people that are doing whatever the heck they want, but you do your thing. So that's what I apply to it. If you're doing single equities, you should invest in companies which you believe will be around for the next years, and not just I don't know, for the next 2 days, like all those companies that went out of business, like Sears or those kind of places.
Macy's, all those,
Exactly. So that's the logic, I think, behind it. You need to believe in the future of those companies, because that is the goal, to make your earnings greater in the future. That's why you invest. You don't invest to just catch losses.
Exactly.
It's about future gains.
Yup. As Warren Buffett says, and I'm going to end off on this quote. I love this quote. Warren Buffett's rules for investing. He has 2 rules for investing. Rule number 1, don't lose money. And rule number 2, never forget rule number 1.
Bruh. That's interesting. But yeah, thank you for watching the video. Hopefully you learned a lot from it. Don't forget to leave a comment. Destroy the like button or something like that. And yeah, see you guys next time.